The following is a presentation of TFNN. The Global Market Pulse with your host, John Logan. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, John Logan.
Hi, guys. Welcome to the show. We're in eastern North Carolina today, down at the probably the biggest grain area in this part of the state. And we're outside in Little Washington, North Carolina, with the backdrop of the Pamlico River here. And I hope you guys are feeling for me here, because it's about 39 degrees and I'm outside and I'm sitting on my hands, so we won't have a lot of mouse movement today. I hope you guys are enjoying the view behind me. It's just incredible. This is the Pamlico River, where the Tar River meets the Pamlico River. And if you want to look on the map, it's a really, really cool area. And Jay, this is probably Chesapeake-esque, I'm assuming, but a lot of cool spots in eastern North Carolina like this. A lot of water. If you look at the landscape of the sound on the maps and the Outer Banks and all the rivers that come in, it's a really cool area. It's very unpopulated too, which is also cool. So let's get right into it. I'm going to have a guest in just a second from down in one of the grain elevators here, and we're going to talk about some of the processes that happen there and what what's going on with the farmers and how those type of contracts come in, their hedging techniques when they've got grain in the field they've already committed to, and they have to obviously transfer that to producers. And that's going to be hopefully an interesting conversation after the first break for you. But let's take a look at the Shanghai real quick. Now, we talked about this. My God, it's cold out here. We talked about this 28.13 down into 23.71 area, and what's happened here is we've had weekly close last week pretty much in that hole in the marketplace, and we're rallying back up a little bit now, but all we're doing for all intents and purposes is this is our daily situation. Our unfair high is on our daily 27.82, and as you can see, when these profiles are outputted and that yellow peelback happens in the scanner and you have these new balanced areas, these are inflection points that are in force for an amount of time that we don't know is based on the algorithm, but they're static and they're going to stay there, and they're things that you can lean on. And what I'm looking at this as right now is that we kind of pierced that hole. We've gone back and retraced up to the top of the hole, and that coincides with that unfair high on our daily. And this is just the way it is when it comes to instruments in a downtrend, going back, rallying back up into resistance. And as I go into our index heat grid here, the Shanghai, this is our weekly rankings as far as net profile calculations. Shanghai is still in the cellar. If I pull this up, you'll see some hints of it turning around on the long term. But remember, here's our daily situation. Here's our 1 hour. Got into some positive territory on the short term, but just basically rallying back up into that. Remember, long term takes precedence over intermediate down the line when it comes to inflection points, and that's basically turn around, it's the same way type of situation. Sell resistance on the Shanghai till told differently. That being said, we're going to move around a little bit here and follow some of the usual suspects that we cover every morning before we start getting into some grain conversations. The dollar, again, we talked about this. 97.40 is going to be a lid on this right now, and it seems like the worm has turned. The technical damage is there. This is our weekly situation where we've breached that profile in the long term around 98, and that's kind of Custer's last stance for longs on this for a while. So there's really nothing to do with that from the long side whatsoever. Here's the S&Ps. And what we have right now on the S&Ps is, we talked yesterday about, I think the leverage is more than likely to the long side. And I said I'd love to see this thing compress up against this 1918, 1912 general area, and then have a chance for this compression to really pop. And that's kind of what I'm looking for here on this. I know we've got a mixed bag when it comes to breadth and Here's where we kind of closed yesterday. We don't have a lot of stocks open yet, but this is the situation on our short-term and intermediate breadth. The weekly still, if you look at this, and again, we crossed into negative territory. We flirted with negative territory in the middle of December, and then we kind of carried through and followed through at the first of the year. Don't see anything really, changing here, but I like the way this action is happening here. I'd love to see this inflection point pierced at 1918 and especially get a weekly close again and try that just like we did last week. Not a big fan of going short the S&Ps right now. Let's go back to our ETFs. And again, we're looking at a long-term ranking system, intermediate term, and I'm just pointing out this XLU is still the shining light here. Still on the top row no matter what time frames you go by. And you look at the energy stocks, we're going to have to take a look at crude oil before we look at that. So what we're going to do is we're going to head into our e-signal charts, and we're going to scroll down, if my fingers can move still. We're going to scroll down and look at crude oil, look at the March contract, and here's the daily situation. Again, in the middle of a balanced area. That's the top of the hill, this POC right there, pretty wide profile. As you can see, day before yesterday, we were able to kind of catch a bid again at 29.26 in that neighborhood. So what do you do with it now? In my opinion, you've got, there's been some fundamental news out that obviously some people who drill a lot of oil wells and do a lot of processing as far as crude oil and the gasoline, they're going to cut supply, blah, blah, blah. It hasn't really affected it that much. This is going to be, in my opinion, in a trading range at best for a while. This is our 240-minute. This is the short-term numbers, if you want to know, 30.96, 32.63, which is, again, I'm looking for a lot of volatility between, 29.5 and 34, 35, 34.5, 35. And that's basically the way that I feel like crude oil is going to act. So how do you take advantage of that? In my opinion, you go into the XLE and you try to find some things that are hanging in there on any type of rallies in crude oil. I think crude oil's kind of found a bottom. So what, I think the low risk trade is to continue to look at the RRCs of the world, the SEs of the world. Let's pull these up. And again, I keep talking about these, but it's just the easy pickings type situation when it comes to relative strength. There's RRC. Again, I hate to keep beating a dead horse, but when there's opportunities on the board, I feel like you just have to take advantage and keep going to the well until we're basically told to not go to the well anymore. Southwestern, been that really cool trade. Been able to kind of hold up and show the strength. Whenever crude oil rallies, we seem to get a little bit of a bid in this thing. And this is the situation on the 1 hour. If I can pull that up. There we go. Holding steady pretty well. Cabot Oil, same situation. Guys, we're going to go to break, and then we're going to talk grains when we come back here. And we'll be right back.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. John takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi guys, welcome back to the show. We had to switch mics to something that we could jointly talk on. This is McLean Bryce. He's a big grain guy down in the eastern part of the state. We've got a cold morning here with the backdrop of the Pamlico River. How are you today?
Doing well, John. Welcome to Washington, North Carolina. We call it Little Washington because obviously Washington, D.C. is a little bit better known, but I'm pretty sure that Washington, North Carolina was here way before Washington, D.C.
When was this place founded?
1600s maybe.
Good Lord.
It's a pretty old city in North Carolina. Beautiful city. If you can see the river here in the background.
Cool. Yeah.
A lot of pirate trade in the old days. So a lot of trading going on in this little town.
Cool.
Yeah.
Well, what we want to talk about today, I think, is a lot of people out there that listen to the show are relatively big grain traders. They're traders. They're not producers or hedgers or guys who just get the grains out of the field. So what I wanted to do is, it's really interesting to me to talk to you when you guys kind of forward look. You basically buy information and grains out of the field before they're planted a lot of times even, and then you guys take them in, you store them, you move them. You guys deal with Cargill, ADM, all that. So if you could explain the process from kind of soup to nuts when it comes to, basically negotiating things with the farmer all the way into the ADMs and the Cargills of the world.
Well, basically the farmers are growing and thinking about their crop year round, and thanks to the futures markets, they can contract their grain at any time. If somebody wants to contract the grain or the soybeans that they're going to grow next year, right now we can give them a price for it, thanks to the futures markets.
And how do you guys kind of not have all the risk of the fluctuations of, the price of grain on the CBOT relative to what you told the farmer? I mean, how do you guys kind of work that?
Well, I don't know how deeply we want to go into it, but it's called
deeply.
It's called the basis is the amount above or below the futures price that you have a pretty good idea of what the basis is going to be. I mean, now the basis can change, obviously, just like the price of the underlying futures can change, but typically not nearly as much. It's not nearly as volatile. If, say, March soybeans are at $8, the basis on that is going to be anywhere from 20, 25, 30, 35 cents above or below the futures price. If the futures go up to 10, 12, $14, that basis is probably going to be pretty close to the same. So as long as you can know what that basis is going to be, pretty close to it, you can trade the futures.
Sell the futures.
Yeah, if you buy the grain from the farmer, you can just sell the future right then, and then 6 months, 8 months, a year down the road, when you sell the grain that you bought from the farmer, you buy the futures back, and the futures will offset each other, and so you're not really speculating in which way the market's going to go.
So what happens? Like, I mean, I know you guys have dryers.
Yeah.
You know, so farmers are bringing in beans that are not completely wet. They've done what they've had to do basically, and you guys, what happens? You know, when what's the start of that process and what's the end of it?
Well, I mean, as far as drying beans, you know, probably getting a little bit technical here, but there's a maximum moisture in beans that they have to be at a certain moisture, yes, for them to be usable. And so if they're not at that moisture, you have to put them through a big grain dryer, which is basically just a service that anybody in the grain business provides. And, you know, it costs money, so there's a discount on that. That really doesn't have anything to do with the futures price or the price that you paid the farmer. I mean, that's just standard across the industry.
What's like a tolerance for moisture content on beans, for instance?
13%. 13% moisture is a usable or dryer, and if it's higher than that, then it needs to be dried down to at least 13%.
So if somebody brings in moisture content 17 or 20, you guys are just going to dial it down to 13 via the dryers, right?
Yes, typically they will not. Most of the time, the farmers will not pick the beans if they're 17% moisture. They'll wait until the weather, till nature takes its course and the beans naturally dry down themselves. This year, I don't know if you can see the background, it's very cloudy and it's kind of dreary here, although still beautiful. We've had an incredibly wet winter, and it rained and rained and rained. And so on top of the farmers not being able to get into the field to actually pick the beans gathered a lot more moisture than they usually do. And so it wasn't even a question of, I'm going to wait till these beans get dry in the field, because it just wasn't happening.
And what was the net result of that? There's a lot of damaged beans in this area in particular, right?
Yes, there were a lot of damaged beans in the southeast. And the quality was very low, and of course, consequently, there are discounts taken for the damaged product, and it's not been a great, to say the least, it's not been a very good soybean season for us here in the southeast.
How do you guys factor in? Okay, you've hedged almost like a perfect bean, not a damaged bean, and then you guaranteed the farmer certain. Like, do you guys just kind of negotiate that with the farmer, and then kind of negotiate it with the Cargills and the Purdue's of the world?
Well, typically the damage.
I told everybody you guys get screwed on that one deal.
I'm not sure. I'm not sure what you're talking about. But
well, you know, when they basically lowered the 25-cent thing.
Yes. There have been some modifications in the damage discount schedule this year, which has kind of was a little bit tricky to negotiate. But typically, this has been, again, probably the worst soybean season in 25, 30 years.
Around here.
Yes, but typically the discounts that are built into the market, to the discount schedules that the end users have, that all kind of takes care of itself. I mean, you still pay the price for the bean, but then it gets discounted based on damage. Usually, most years, it's never an issue. Most of the time, there's very, very little damaged beans, and most people will not pick their beans until they're maybe 14% maximum. Mm-hmm. So there's not much drying that needs to be done. But this year has just been a real curveball.
Nightmare.
Yeah, pretty much, yes.
So if something comes in damaged, what does, is there some like external player that takes on that damage, or does Cargill and ADM say, you know what, this is a low quality situation? What are they doing with that type of situation?
Well, this year they have, again, it's been a highly unique, unusual situation. But this year, for instance, the Midwest had a fantastic growing season for soybeans. The beans were perfect, more or less perfect. And of course, in the Midwest, the amounts that are, the volume that is produced in the Midwest is tremendously more than what's produced here in the Southeast. And so what they've done this year is we've basically taken a lot of these damaged beans and shipped them down to the Gulf, and they're going to get blended and mixed in with these really good beans,
Okay.
and so the overall product will be better.
Well, we're going to head to break. Can you hang around?
Sure.
You don't have anywhere else to go, right? All right. We'll be right back, guys.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Yeah, what do I want to do here? I want to look at the notes really quick, guys, before we keep talking about grains here. Got a little bit of a report that came out. Not a lot of volatility. Again, we talked about the 10-year the other day. I'm showing this on our target in charts here. Had a hint of a new profile attempting to appear yesterday, and again, that kind of disappeared. Remember, that was just, again, not a profile locking in, just a hint of one attempting to appear. Having some sell-off here in the in the 10-year. But let's go back to the S&Ps and see what's going on. A little bit of a down reaction. I'm still relatively bullish on stocks. We're going to have to see how the breadth opens up with the internals opening up. But let's see here. Down about 7 on the S&Ps right now. Dollar rallying a little bit. Nothing really to write home about. Just some volatility after the report. People adjusting positions. Going back to the 10-year again, pretty stable. Again, nothing to write home here about. Here's the 240s on the 10-year. New profile has appeared. Downside's going to be 129.32 on, or excuse me, 129.31 on the short-term trading. And remember, the long-term trade is really still in force here on the 10-year. Okay. All righty. So let's get back to talking about grains here while it's in the high 30s outside. And remember, Eastern Grain, this is what the company we're talking about. So, what about, this time of year? We were looking at the March contract in beans. Let's just stay on beans for a second. And by the way, we're with McLean Bryce out of Eastern Grain in Eastern North Carolina. Let me pull up the March contract on beans again. What in the world could affect, because we've been talking about, or I've been talking about, kind of a trading range for March beans for a while. What could affect the price of March beans at all at this state?
Well, that's what I was going to ask you, actually. Typically, my customers, the farmers that grow the grain, they're always asking me, what are beans going to do? What's corn going to do? Because naturally, they want to sell their corn or their beans at the highest price that they can.
Right.
And typically, I don't know. And I look at your charts and everything that you do based on what the market has done in the past, and I'm just I'd like to
gauge
know.
It just the same.
Yeah, I'd love to know what beans are going to do too, so I could tell them, or so I could.
Right. But do you see anything impacting the March contract price really in any big ways, or anything any scare that could even happen in the next,
Well, I mean, typically the things that we talk about when we talk to our customers is basically supply and demand. For instance, as we just talked about in the last segment, we've had a pretty bad year here in the Southeast for beans. However, as always happens, what happens in the Midwest is what really drives the price of the bean market.
Right.
They had a fantastic growing year in the Midwest. They grew billions of bushels. The supply is very high, and so now the price is in the mid to high $8 range.
Right.
That's not helping our guys because they've had a terrible crop.
Right.
Well, 2 or 3 years ago, there was a drought in the Midwest. We had almost perfect growing conditions here in the Southeast. Everybody had a huge crop, a bumper crop, and the price went through the roof because the Midwest had a terrible growing year.
Right.
And I guess my question is, that's something that I can understand. There's a huge crop in the Midwest, so the supply is really high and the price comes down. Basically, supply and demand, which I guess is what you call fundamentals. You're looking at the charts and what did it do in the last 120 days versus the moving average versus what did it do in the last 10 seconds, and trying to predict what it's going to do in the future. I just like everybody else, I'd like to know, but from what I've seen this year, what affects the market is if there's a big crop in the Midwest, the prices typically come down. Or like 2 years ago when there was a drought, beans were trading for $15. Almost double what they're trading for now.
So you guys are paying attention to the fundamentals mainly surrounding the Midwest, but okay, let's just kind of go back in time to 2 years ago. Let's just say that the price of beans spiked up because of that drought situation. There was no problem here. Do any farmers kind of look at you in a weird way going, why did you convince me to sell now at $8.50, lock it in, and beans are trading $14? Does anybody ever default or try to can I get out of this thing, or is that just not something that ever happens?
No, the people we deal with are good, honest people, and I can't remember maybe one instance where somebody didn't deliver what they said they were going to deliver because of a price change. And typically, I mean, the farmers are pretty astute businessmen themselves, and they understand that, if I sell something at this price, I'm going to stand behind it, and I'm going to deliver at this price. And I typically don't ever try to convince anybody to do anything, because I don't try to represent myself as knowing what this market's going to do, and I typically would almost always tell a farmer, don't sell your whole crop, and they wouldn't do that anyway. They might sell a little bit.
Some
of
them take
price.
chances then.
They take a little chance.
Okay.
They might sell a small piece of their crop, and then if it goes up some more, they'll sell a little bit more, and if it goes up some more, they'll sell a little bit more, and so they kind of
That's smart.
try to average it out. Or they might sell some, and if it goes down, then you try to emphasize, well, at least you got some at a higher price, and now maybe you should try to sell a little bit more before it goes down anymore.
So the guy that was trying to default, do you guys ever send anybody over to burn their silo down or anything like that?
No, we don't.
Never?
We don't get into that.
No, nobody. Okay, no. All right, that's
no,
good.
no.
That's nice to know.
But again, I will repeat that has not been an issue for us anyway, not with the customers we have.
That's a great question, John from Philadelphia, and this is actually because I know Ricky Hart over at
Goldsboro
Milling and all those guys. The question is, how big is the business of importing beans from Brazil to feed pigs, chickens, turkeys, and all that in North Carolina? I know they did a huge deal where they locked in prices out of Brazil because they were concerned 2 years ago.
Yes.
Can you review that? We got about a minute or so, and then we're going to come back and get deeper about it. But just brush on that.
Okay. Well, as you said, what would affect prices in the March bean contract right now? And again, not knowing anything about the technical analysis of why is it doing this or going up and down, or the 30-day charts. The obvious answer is it's the growing season in South America right now.
Okay.
Are they going to have a big crop? If they have a big crop, then the prices are probably going to stay near where they are now, or maybe even go lower. If there's some disaster in South America, which
Right.
it doesn't appear that there's going to be, that could drive the prices up.
Right,
Basically, supply and demand again.
But when we come back, we have about 30 seconds. When we come back, I want to talk about, and maybe to answer that question, when they were terrified, from what I understand, and they just basically said, you know what, we're going to go ahead and lock in some things in South America now, way ahead of time. I mean, and I want to talk about how far ahead of time did they try to do that, and what are the guarantees on something like that? I mean, I know that was maybe noted as one of the largest transactions ever to import beans, right?
I think so.
Okay. Well, we're going to come back from break, guys, and we're going to try to answer a couple more questions when it comes to the internals of the grain operation.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that
many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, guys, we're back trying to get the settings here right on the backdrop here. So you can see this fine scenery in eastern North Carolina. We're with McLean Bryce from Eastern Grain, and we're finishing up that bean. That was kind of a, just something that was that bean importation thing that we were talking about was just something that was just based on a massive concern that commodity prices were going to go through the roof forever, right?
Well, that and the supply in the Midwest again. I mean, if the supply is good in the Midwest, you can put and you put them on trains and bring them over here to eastern North Carolina. We grow a lot of livestock, chickens, turkeys, hogs, and they got to eat. And we don't grow enough here to feed them all by nearly enough. So we have to bring in the food supply from somewhere. If there's plenty in the Midwest, it's easy to put it on a train. If there's not, then you go to South America.
Right. Okay. Thanks. The corn situation. Let's talk about corn. I got the March contract up here on the weekly, where it looks like we're trading about 360 in that general neighborhood, somewhere in there. Did you ever think you'd see corn back down in the $3 range again?
No. When I first started in the grain business, corn was in the low $2, and soybeans were maybe $5, wheat was maybe $3, and within a couple of years, corn had gone to $5, $6, even $7. Beans had gone through the roof. Wheat and corn a lot of times moved pretty consistently, not always.
What was the big cause for corn to just ratchet up? I mean, what about this ethanol thing, and how does that play into this?
Ethanol is a huge factor in the price of corn. Probably 1/3, maybe more than that, of the corn grown in the United States goes to ethanol production, believe it or not. And obviously the price of fuel affects that tremendously.
Right.
Right now, gas at the pump right now in East North Carolina is about $1.60, $1.70,
something like that.
So when gas prices are low, an ethanol manufacturer can't make $1.70 a gallon gas with $8 corn. There's just no way.
Right.
And so corn, obviously the fuel, the gas price, the price of fuel affects the price of corn a lot more than you would think.
Right. So what's the status on, like, if there's no money to be made on ethanol relative to the price of corn right now, is there kind of a snowball effect, like, okay, well, that's not going to be there as a subsidy and a valid business model? I mean, is that going to be something that could possibly even drive the prices lower?
That's a great question. I would say the $64,000 question is probably a $64 billion question. Who knows, especially with electric cars coming into play now, what's going to happen there?
Right.
Who knows? But right now it's a viable industry. You mentioned subsidies. A lot of factors go into these things: government subsidies, demand from ethanol, supply, the grow, how much is produced. But I want to ask you, as I said earlier in the show, my farmers, my customers are always asking me, what's corn going to do? What are beans going to do? I'd like to see some of, why don't you tell me what corn's going to do in the next 30 days? Pull up your chart and tell me what corn's going to do in the next 30 days based on what you do, which is not what I do. But I'm very, very interested in this.
Right. Well, technical analysis, we just try to guide people in the direction of, hey, it's kind of okay to be long or okay to be short in that type of scenario. Trying to block out one side of the marketplace is the way that some of the information that we display predicates that decision. And, one of the things that, I've been bearish on grains in general for a long time. So any type of resistance that's hit is just an opportunity to short more. And we've had some situations in beans in particular, actually, when we ran up to like 9.10 a bushel or 9.15 or whatever it was this past spring, where we actually broke out of a situation, and the next level up to whack kind of the head off on the short side of beans was up there. So, it's almost like, situations are breached as far as technical levels, and then you kind of have to wait patiently and either till some new information appears, or you're basically coming up into a longer term ceiling. So, to answer any questions on corn right now, I don't see, this is our daily on corn. It's kind of been languishing around.
Yes, it has.
What do we go down on the March contract, down to 350?
Something like that, yeah.
Yeah. So, I don't see any reason why that really shouldn't be revisited. I don't know about the time between the time this contract expires or now the contract expires, but what about kind of looking towards the summer? Because the wheat and corn contracts in July, in that scenario, you start getting some kind of new crop versus old crop situations and a scare about supplies and things like that. You guys hedge. Are you guys basically trying to hedge those bets in the summer now based on wheat in the field now? How do you hedge that? Are you doing just strictly futures contracts, or are you doing option plays? What's the safer way for you guys? Because I remember a couple of years ago when wheat was just incredibly high.
It was chaos.
Yeah, and being short futures contracts, there's not a lot of, hey, we're going to deliver, don't worry about it. That's a margin that has to continue to be met.
Correct.
You guys are short the contract. So how do you guys mitigate like new crop, old crop, and the volatility that happens? Like what's the hedging strategy, if you will?
Well, there had really never been volatility, anything even close to that with the situation you were talking about. I believe wheat, the July wheat contract went to $13 or something ridiculous. And so obviously if you're short futures at $5, you're pretty nervous about the margin calls, as you said.
Right.
That had never been a situation before. We had to think fast, and we pretty much have gotten into some using some options but not speculating, but to offset some risk if that ever happens again. We're going to be more prepared, and I think you just have to live through something like that and experience it before you know what to do in a situation like that.
Or is there any negotiation with the span requirements or whatever at the CME or CBT on, hey, trust me, I'm going to deliver the product and I'm a hedger, and give me a little rope here as far as the margin requirements? Is there any of that play, or is it like, hey, I got to go to the bank and borrow money to meet the margin requirements?
Well, there were both, yes. And there was a lot of hand wringing on all the way up the food chain, from us, from the farmer, all the way up to the banks. And it all ended up working itself out, and wheat prices did drop considerably from the 13. They still stayed very high, but again, we didn't have any problems with deliveries that year. But it was a very stressful time.
We're going to get our last break, guys, and we'll be right back.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Hi, I'm Steve Rhodes, host of the Trader's Edge heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartleys, butterflies, ABCs, and Fibonacci in order to trade these markets. Trade what you see. Next on TFNN.
Hi guys, thanks for coming back. We're got about 4 minutes left. We've got McLean Bryce from Eastern Grain in Eastern North Carolina here today, and we were using the whole hour basically talked about the mechanics of the grain markets around here. You know, one of the things I'd like to know about, you know, we've had a super wet situation here in North Carolina. I think the average rainfall for it was above 12 or 13 inches above average rainfall in 2015. The wheat that got put in the field around here now, what's the story?
Well, the story is a lot of wheat didn't get put in the field because of the rain that you're talking about that messed up our bean crop, and it was too wet to plant a lot of the wheat, and then a lot of the wheat that did get planted was drowned. So we're going to have a severe shortage of wheat in Eastern North Carolina. So in my little world, my thinking would be, wow, wheat prices are going to go up. But again, it's really what happens in the Midwest that dictates the price. I mean, there's basically a pipeline.
Right, but let me ask you a question. Where I was heading with this is you guys are basically have guaranteed some people some prices on some wheat around here, right? Is that fair to say, or is that not even in play yet?
Not much. Not this year.
Really?
Nobody wanted to sell any wheat ahead of time because of the conditions. That nobody wants to sell wheat that they're not sure they're going to get planted or be able to produce.
So it's always baffled me. Let's just say somebody thinks they're going to get, I'm just going to pick a number, a whole number, 100 bushels of wheat off of an acre, all right? And let's just say that you guys have kind of hedged that, and then they only come up with 60 bushels in this type of situation. What's the story there? Does insurance come into play there, or like what happens?
No, typically nobody books the maximum of what they think they're going to get, and certainly not based on the most optimistic forecast of what they think they're going to get. Typically, most farmers are only going to book, I mean, if a farmer books 50% of what he thinks he's going to get before it's harvested, that will almost always be the maximum, for the very reason of if he doesn't make what he thinks he's going to make, he doesn't want to be on the hook.
Right, but doesn't insurance come into play that kind of mitigates that with, and then you guys kind of get paid from him as he gets paid from the insurance company?
Insurance is a whole different ballgame.
It's a scam?
It's not a scam, but there's so many different types and parameters of insurance, and some farmers don't have insurance. So I mean, insurance does not really come into play typically.
Some farmers don't have insurance.
Some don't.
Wow.
Yeah, just like right.
Yeah, but
I mean, and then there's various. Yeah.
Okay. So, so we got about 45 seconds here left today. What would be your last kind of statement today about the corn crop as it's going to be coming in this summer? Would you say we're going to be kind of trailing down on the summer contracts, or trailing up? What's your gut feeling on that?
Well, typically, I mean, in the summer, as I was tried to say before about the pipeline, when the pipeline is full at harvest and into the spring, there's not much excitement. In the summer months, that pipeline is starting to get empty, and the buyers of the corn start getting more active. Yes. Right. So you typically do see some run-ups in the summer for corn based on, again, supply and demand, again, the fundamentals of the situation.
Sounds good. Thanks for joining us today, man.
Thank you. Good to see you.
McLean Bryce from Eastern Grain. We'll be back again tomorrow, guys. Stay tuned for Larry. He's next.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This is TFNN.